If you've got money in an index fund right now, I want you to actually hear this because the market just hit its second most expensive valuation in 140 years of recorded history. And the first time it was this expensive was in December of 1999. And most people don't know that. And most people aren't positioned for what that has historically meant. That's what this video is going to be about. If you don't know me, I'm Alexandre Allemand and I founded Kronos Trading back in 2021. And over the years, we've built a fully automated trading app that's returned roughly 53% a year ever since, across 300 partners and about 20 million US dollars under management. So the whole point is to protect your downside, beat inflation, and outperform the market without you needing to touch a screen. And right now, what I'm seeing in the data is making me generally rethink my own positioning, which is why I want to think through it all out loud with you today. So stick around because toward the end, I want to show you one signal that worries me more than anything else in this market right now. But first, how do we actually measure whether the market is expensive? So the most reliable tool that everyone kind of consensus around that we have available right now is called the CAPE ratio, which stands for cyclically adjusted price to earnings. And it was built in the early 1990s by a guy called Robert Shiller, who's a Yale University economist, and he later won the Nobel Prize for this work. And instead of just looking at last year's earnings, which can be distorted by a single good or bad year, it's basically smoothing out company earnings over a full decade, which gives you a much cleaner picture at the earnings. And what Shiller proved, going back through 140 years of data, starting in 1881, is that where this number sits today predict with remarkable consistency what your returns are going to look like over the next decade. So the historical median is about 16, and right now it's sitting at 41.6, which is more than 2.5 times the median. And the only time in 140 years we've been higher than this was in December of 1999. And Invesco, which is one of the largest investment management companies, they manage almost $2 trillion in assets. They went back and ran this across every market cycle since 1881. And what they found is that anytime the CAPE has been above 30, the average annualized 10-year return from that starting point comes out low single-digit negative. So what we can expect, and I want to be clear, is not necessarily a dramatic crash, but it's more like a decade of basically nothing, while inflation, however, will continue to quietly eat at what you have. So having said that, the bulls have a generally strong argument this time around, and I do want to give it a proper hearing. Goldman Sachs projects full year 2026 earnings growth of about 23% for the S&P 500. And so far, Q1 earnings actually back that up, with about 84% of companies beating their estimates. So what we see today aren't the profitless dot-com companies of the 2000s with no revenues. We now have Apple, Microsoft, Nvidia, all these things are literal money printing machines. And there is a fair technical criticism of CAPE as well, specifically CAPE, that I wanted to touch on as well. It's that it doesn't account for interest rates. So the argument is that during the 2010s, when rates were basically at zero after the 2000 financial crisis, investors rationally paid more for future earnings because there was nowhere else to put money into. So valuations naturally expanded. Right? And some people argue the new normal CAPE is structurally higher than the old median of 16 because we're in a different rate environment than the 1800s and early 1900s when a lot of that historical data was actually gathered. Okay, so I held that view for a while, and then I found a second signal. And it actually has to do with Warren Buffett himself, who, is widely considered the greatest investor of all time. He said publicly that his single favorite market valuation indicator is the ratio of total stock market cap to GDP. GDP meaning the total size of the US economy in this case. So the logic being, if the entire stock market is worth more than the entire economy producing the earnings behind it, then it means that something is stretched beyond what the fundamentals can actually support. And Buffett himself called it probably the best single measure of where valuations stand at any given moment. Healthy historically on this indicator sits around 100%. And right now, as of today's recording, which is June 9th, it is at 231%. Advisor Perspectives, which is an institutional research firm that's been publishing market analysis for professional financial advisors for more than 20 years, they even called this the second highest reading in recorded history. And they also noted that it's sitting at more than 2 standard deviations above its long-term trend, which in statistics basically means that we're about as far from normal as this indicator gets. Now, the counter argument is that nowadays US companies earn globally. Apple, Microsoft, they aren't purely American anymore. So comparing their market cap to just US GDP kind of understates the real earnings base, which is a fair point. I'll give you that. But it was equally true in 1999. And that peak was still lower than where we are today. So these are 2 completely independent frameworks that I just outlined. They're both at historically extreme levels at the same time. But now I want to tell you about this other signal I mentioned at the beginning of the video. And it's the one that bugs me more than either of those. Since March 31st of this year, the S&P 500 went up 16.2%. And over that exact same period, forward earnings estimates, basically what Wall Street analysts are projecting companies will earn over the next 12 months, they went up 8.2%. And these figures come from a financial data company called FactSet, which is a company that Wall Street firms actually use to track earnings estimates. So these are the figures the professionals actually are looking at. And what that means is prices climbing almost exactly twice as fast as the earnings underneath them. So the market isn't getting more expensive because companies just suddenly got more profitable. It's getting more expensive because people are just willing to pay more for the same earnings. And Goldman Sachs themselves flagged a specific tension inside of that. The AI semiconductor stocks at the heart of this whole rally that we've seen have already outrun even their own forward earnings growth. So there's definitely a fault line even inside the bull case, okay? And to top it all off, sitting underneath all of this are the Magnificent Seven. So I'm sure you've heard this argument, that's Apple, Microsoft, Nvidia, Amazon, etc. And they make up roughly a third of the entire S&P 500 by market weight right now. So when you buy a broad index fund, you think you've got like 500 companies, but you've really got 7 and 493 along for the ride. So if we look back, we've got 3 independent signals. We've got the CAPE sitting at 41.6, which is the highest in 140 years of data. We've got the Buffett Indicator at 231%, which is also the second highest recorded. And we've got prices running twice as fast as earnings. And again, I want to reiterate that I'm not calling a crash because nobody knows when this thing is going to turn. But what I found the consensus to say is that the implied annual return over the next decade is about 1.6% a year, which is very unlikely to even beat inflation. So here's the one thing I would actually do tonight. Go pull up your portfolio, find your index exposure, and honestly ask yourself, if the Magnificent Seven repriced, say, 30%, how much of your money will go down with it? Okay. And most people have never even run that number. So figuring it out is actually where this whole conversation starts, which is how do you safely manage your risk? But that's a topic for later, because the next video is going to be about the AI earnings argument specifically, because I know that's what's sitting in the back of your head right now, going like, yeah, but maybe this time, what if it's different? So it deserves a real answer, and that's exactly what the next video is going to be about. I'll see you there.